stocks and things like that, but I want to go over some of the process. And what I'm going to do for everybody who's in attendance, I send out a weekly letter to all of the All-Star Charts members, people who pay for my research, whether they are, we have financial advisors and brokers and traders who pay for my research, but we also have retail investors that are managing their own portfolios, lawyers, doctors, plumbers, florists that are managing their own portfolio. So I send out a weekly letter kind of talking about what the overall U.S. markets are doing, talk about the indexes, what's happening globally. You'll break it down to individual sectors, individual stock ideas, both longs and shorts, talk about bonds and interest rates, commodities and currencies, and really break down and just talk about what I'm seeing around the world. I like to do that on a weekly basis. So I'm going to go ahead and send that out to you guys this week. So make sure you look out for that email. I'm just going to give it to you free, just an added value add for attending the Charts Summit, which so far, I don't know, feel free to comment. You guys have been commenting all day. I personally am thrilled with this whole thing. We've had more registrants than I could ever imagine having. We're going to have at the end of the day over 10,000 people around the world watching what's happening here today. And even if there were 0 people around the world and I was the only one watching, I would have signed up for it all day. So I hope you guys are getting as much value as I am out of this. This has truly been such an awesome couple of days. So I look forward to what we have for the rest of the day. All right, so what I'm going to talk about is I want to start out just kind of telling you guys a little bit of who I am. I'm going to do that very quickly. Most of you guys already know me. I'm going to talk about how I manage risk. We talk about risk management, but how do we do that? So I'm going to show you guys my process on how I do that and how I position size accordingly. Then I'm going to show you guys the top-down approach. I know Ari showed you how he does his top-down approach. I know Krinsky did that as well, so you've seen some of that. So I'm going to show you exactly how I do that step by step. Along the way, I'll give you guys some ideas because as I show you my top-down approach, I'm actually going to incorporate today's current market environment during that part of the presentation. And then I'll explain to you guys what the weekly letter is going to talk about. So just quickly about me, I started at 21. I was young. I grew up in Miami. I went to college in Fairfield University in Connecticut. I was fortunate enough to play baseball there, and I earned a degree in finance. I was an accounting major originally, hated it. It wasn't until I had my internship at Merrill Lynch while I was still in school that it really pointed me into the right direction and really opened my eyes to how much I truly hated accounting and how much I appreciated the marketplace and stocks and commodities and things of that nature. So early in my career, I hit that fork in the road, and I was young, very young, wet behind the ears, and I was aware enough to recognize that people around me, twice my age, 3 times my age in some cases, really felt as though they had a handle on things. These are wealth managers managing hundreds of millions of dollars, if not billions, in some cases. These are brokers, these are analysts, sell-side analysts, and they really did feel they had a handle on things. And I guess I'm just lucky enough to have been aware enough at the time to realize these guys didn't know anything. And it really scared the hell out of me. And here I am, 23, 24 years old, and I need to learn something right away. So that's when I hit that proverbial fork in the road. Okay, do I study for my CFA and learn about fundamental analysis and learn about companies and valuing them? Or do I learn about technical analysis and study for my CMT and learn about stocks and intermarket analysis? And, at the time, I didn't care about companies. I was trading stocks. And, little did I know how much that decision would impact the rest of my life, my career, my life. I mean, everything. It really, shaped my path. And, I basically just started reading everything I can get my hands on. And, this is going to be archived. You guys can see this. Obviously, there are a lot more books. Here's Brian Shannon's book right here that we were talking about earlier. A couple of John Murphy books for sure. Market Wizards that Joe Fahmy mentioned. Technical analysis of stock trends, which is, in my opinion and in the opinion of many, the Bible of technical analysis. Here's the little book of stock market cycles written by Jeffrey Hirsch. So a lot of the authors here, you've seen present. I think you need to read all of these. I've read them all multiple times. So I passed all 3 levels of the CMT. This was in 2008. And by 2010, as we discussed yesterday with Phil Perlman and Howard Lindzen, I started allstarcharts.com as a blog. A couple years later, I founded my own company. And in 2014, I started this research arm that, slowly but surely has turned into one of the fastest growing technical analysis research firms in the world. And I really am proud to say that we've seen tremendous feedback from our members, both pros and retail investors. So I couldn't be more proud. And I've had the opportunity to be featured, on Bloomberg and ABC, Wall Street Journal a million times, CNBC, CNN, Yahoo Finance, and it's really given me an opportunity to meet a lot of these people that you see here today. The people you're seeing, these are my friends. Like I told somebody else. I mean, it's nice to have really smart drinking buddies. And a lot of that is what you see here. And I'm lucky that you can go to allstarcharts.com/testimonials and see what people are saying. The emails that you guys send me, and BNN, yes, Tom, at Business News Network in Canada, Frances Ordelsky, she's one of my favorites. So yes, I did BNN a lot. But the emails you guys send me, just thanking me, for my research and telling me how much money you guys are making. I mean, I can't even tell you how much that means to me. Sometimes, my mom reads the testimonials page and starts crying sometimes. So it really does mean a lot. So thanks a lot, guys. So let's get into it. So why are we managing risk? Why is this so important? This thing of risk management, and it's really simple. One bad trade. That's all it takes. One bad trade. You can have 10 great trades in a row, base hit after base hit after base hit, and then you just put way too much money and way too much risk on, and you are wrong, because it does happen. I promise you, you will be wrong, and that just literally crushes you. So the way that we want to approach the market is by keeping in mind that it's a lot easier to hold on to the money that we already have than to go out and make more of it. So our number one priority when we're approaching the marketplace is not to go out and make as much money as possible. It's to keep as much money as possible. That's really what it is. So, Bear Bryant, famous head coach of Alabama, he said it best. Listen, offense sells tickets, but defense wins championships. And while that might be the case on the gridiron, I promise you from the bottom of my heart, that's the case in markets. And you can ask Ari Wald, or you can ask Jonathan Krinsky, and you can ask especially Peter Brand, who's coming on next, and ask them what they feel about that. And I promise you they will certainly agree. So a couple of terms that I just want to go over before we go over the math of risk management. So position sizing, these are the number of shares we're going to buy in a trade, or futures contracts that we're going to buy in a commodity, or currency, or options contracts for that matter. So the position sizing is what we're trying to figure out. How many shares do we need to own? The risk per position is something that we want to make sure we know. How much money are we willing to lose on any given idea? Great. Krinsky thinks Intel's going higher, terrific. Or, so-and-so thinks that oil's going higher, terrific. But how much are we willing to lose in the off chance that we are wrong? Because it is going to happen. And then the last term is the stop level, right? So this is the predetermined price where the security, whether it's the stock or the futures contract, is automatically sold in the case of a long, or covered and bought back in the case of a short, right? So I want to reiterate the predetermined price, okay? We want to know where we're out before we even get in the first place, okay? So before we enter the trade, we want to have our targets to the upside in the off chance that we are correct, and we want to have our downside to where we're wrong in the off chance that we are wrong, or in the likelihood that we are wrong. So the first thing we want to do is determine the stop level. So let's just use an arbitrary example. This is not a real thing. IBM's not at $100, but let's just say that I want to buy IBM at $100 for whatever the reason, because my research tells me that I think it's going to 120. Maybe it's some Fibonacci extensions, measured move, form of resistance, whatever it is. JC's research says IBM, I think, is going to $120, and currently it's at 100. And then if the stock breaks down below this support, I think all bets are off. I do not want to be long if we are below this support level, which just happens to be at $95, 5%, $5 below the entry level at $100. Okay? So the risk per share in this particular example is $5. So before even going into the trade, I am assuming I am wrong and I am willing to lose $5. I'm cool with that. I'm confident that IBM is going higher. I'm cool with losing $5. That's fine. So now I need to determine the position size. Okay. When it comes to my portfolio, if I want to be uber conservative, I don't want to lose more than 0.5% of my portfolio on any one single idea. If I want to be aggressive, well, I'm willing to press it, but I don't want to lose more than 2% of the portfolio. So no matter what happens, I am maxing out my loss at 2% of the portfolio, and then on average, I'm willing to lose 1% of the portfolio. Not 1% of the trade in the stock, but 1% of my overall portfolio. So I hope you guys understand that. And please let me know if you don't. I can see the chat. So let's just, for argument's sake in this conversation, say that I am willing to lose 1% of my portfolio on this given trade. And given a portfolio, let's just keep the numbers round. Let's just say I have a portfolio of $100,000. If I'm willing to lose 1% on IBM, that means I am willing to risk $1,000 on this trade. Okay? So this $1,000 that I'm putting at risk, and keeping in mind that the stop is $5 per share below my entry point. Remember, we're buying IBM at 100, stops at 95, that's $5. So I'm willing to lose $1,000 of my portfolio, of a $100,000 portfolio, that's 1%, and it's $5 per share of risk. Therefore, in order for me to express this particular trade through shares of stock, I need to buy 200 shares of IBM in order to fully express that. So let's recap. I'm buying 200 shares of IBM at $100 a share. I'm putting my stop loss at $95. So that means the risk per share is $5. My target is 120. So that's 20% of potential upside versus 5% of potential risk. That is a 1-to-4 risk versus reward ratio. So what I would suggest is that everybody here, if you're going to be using this sort of math in order to express your trade in terms of position sizing, I would first determine what sort of risk versus reward proposition is best for you. I personally don't like a 1-to-1. For that, flip a coin, even 2-to-1 or 3-to-1. I would rather have 4-to-1, 5-to-1, 6-to-1, 8, 10-to-1, right? That's what we're going for. We want the ratio from risk to potential reward to be very much skewed in our favor. That's the whole idea. So if you do this math and the risk versus reward is closer to 1-to-1 or closer to 1-to-2, is that really a trade that you want to put on? Is that risk versus reward skewed in your favor? I would argue that it isn't. So the higher that spread is, the more inclined I would be to get involved. So a couple of things to consider when using this math is potentially too much equity. Because remember, in some cases, the entry point is so close to your risk level, right, that the amount of math that would require you to express that trade, given your personal risk tolerance and parameters, might mean that you need to put on 40% or 50% equity of your portfolio. And that might be too much. So one of the things that I would recommend doing is setting a limit of the most amount of capital or percentage of your portfolio that you are willing to put on any given trade, whether it be a max of 5% or 10% or even 20% of your portfolio. I would predetermine that before setting up your calculations. And then just remember that we're all different. Okay, Ari is equity centric, so he's looking at the U.S. dollar and he's trying to figure out how that's going to affect the S&P 500. Some people are much more risk averse, while others are more aggressive, willing to put on more capital because they're younger, or that just happens to be their profession, or whatever the case may be. So just make sure you're aware that you personally have your own unique set of parameters, your own objectives to why you're in the market in the first place. Your time horizon is much different than everybody else, and most importantly, your risk. What I consider risky might seem crazy to somebody else, and to somebody else might seem very conservative. So, just remember that what's right for one person doesn't necessarily mean that it's right for the next. So, one of the things that Josh Brown brought up yesterday in our conversation was, first determine what your personal objectives are, instead of wondering what are the best stocks to buy, or what types of stocks should I buy. First determine what you're doing there in the first place, and what your time horizon is, what your goals are. So that would be my advice for sure. Let's talk about my top-down approach. If you guys are interested in sort of just kind of like my main go-to sort of list of charts that I review, go to allstarcharts.com/chartbook. It's open. It's free. Everybody can see. I mean, if you click on any of the links, you have to be a premium member to access them, but you can see the list at allstarcharts.com/chartbook, so you can truly see where my analysis begins. And then from there are obviously a lot more charts that I look at, but this is really my starting point. So the first thing we want to do, guys, is follow the U.S. indexes, right? Just keep it simple, stupid. Let's look at the S&P 500, the Dow Jones Industrial Average, transports, mid-caps, right? We want to look at all the major indexes and see what is happening in the U.S. And here's my personal list of the ones that I use. And let's talk about what the U.S. indexes are doing currently. Let's think about this for a second, guys, and take a step back. We've seen a lot of charts. We've had a lot of smart people talking today. We got even smarter ones coming on this afternoon. But let's take a step back and let's just recognize what took place this week. Okay, how we ended the week on Friday. The S&P 500 closed at a new all-time weekly closing high. So did the Dow Jones Industrial Average. So did the Dow Jones Transportation Average. So did the Dow Jones Composite Average, which includes all 30 Dow Industrials, all 20 Dow Transports, and all 15 Dow Utilities. The New York Stock Exchange Composite closed at a new all-time weekly closing high. And why that's important is that the New York Stock Exchange Composite brings in companies from around the world. Remember, it's a cap-weighted index, and more than half of the biggest 100 companies on the New York Stock Exchange are foreign, right? They're ADRs. So it's a much broader index globally, the New York Stock Exchange Composite, than some of the other ones. Also closed at an all-time weekly closing high this week. Russell 3000, which represents approximately 98% of all investable assets in the U.S. equities market, closed at an all-time weekly closing high. The mid-cap 400, the S&P 1500, the NASDAQ 100, the NASDAQ Composite. Guys, these are not bearish characteristics. And I know there's a lot of All-Star Charts members here, so you guys know this is not a point that I'm making today based on what happened this week. This is a point that I've been making since July. New highs are not a bad thing. New highs are a bullish characteristic. Markets, by definition, trend in nature. So if we're seeing new highs, there is a much higher likelihood that we are going to continue to see new highs than us just miraculously reversing overnight. So just kind of keep that in mind from a broader concept. My target for the S&P 500 has been 2335. We're quickly approaching that level. It doesn't mean that we can't go higher. In fact, in all likelihood, we will go higher. But just want to reiterate that this target has been in place since July when we originally broke out. It has nothing to do with the election. It has nothing to do with Brexit. It has nothing to do with Donald Trump or whatever lies the media decides to regurgitate these days. You guys would know better than I would. But it's simply supply and demand. This trend did not start in November. These trends have been in place for a long time. And then for All Star Charts members, you guys know we were bullish well before the event. not knowing who was going to win, and for that matter, not caring. The Russell 2000, to me, this is a sideways consolidation after a monster rally. So markets can digest gains in one of two ways. They could do so sideways through time or through a downside price correction. As you can imagine, a sideways consolidation is the much healthier way for markets to digest their gains. And I ultimately think we're heading above 1,500 for the Russell 2000. Now, the Dow Jones Composite Average, I mean, this just gets broader, right? This includes all 30 Dow Industrials, all 20 stocks in the Dow Jones Transportation Average, and all 15 in the Dow Jones Utilities, so much broader. And here we are, all-time weekly closing highs. Doesn't this look, here's the Russell 2000 trading sideways, and then here's the sideways action in the Dow Composite now breaking out. I would expect the Russell 2000 to follow through. And then here's a unique index, guys, that I love and I love using. So this is what I call the All-Star Charts U.S. Super Mega Cap Index. And basically what it is it's an equally weighted index of the top 10 market cap companies. I see Peter. Peter, can you hear me? Peter?
Yes.
Hey, Peter, you're on in about 15 minutes. If you mind putting it on mute. Thank you. Peter Brandt, I'm so stoked to hear what he has to say in 20 minutes. I'll try to shut up as fast as I can to give him more time. But let's finish up some charts here. So what the All-Star Charts Super Mega Cap Index is an equally weighted basket of the top 10 biggest stocks in America, which, as you can see here, includes Apple, Google, Microsoft, Exxon, Berkshire, Amazon, Johnson & Johnson, Facebook, GE, and Wells Fargo. And here we are breaking out to a new all-time high in this index, which I think is very interesting. These are the 10 biggest companies in America, and here we are breaking out to new all-time highs. If you're looking at these market cap weighted indexes like the S&P 500, I got to tell you, these guys are driving it higher, and the fact that we're breaking out to new highs is not a bearish characteristic. So the next thing we want to do is we want to look internationally. Ari and Krinsky both touched on what's happening in Taiwan and London and in some of the emerging markets. But I'm looking at everything all over the world. There's a lot of very important indexes. And before I continue, let me just mention, notice how in all of these or in most of them, you'll see both weekly and daily charts. Getting back to that multiple time frame sort of approach to the market. I want to see what the Shanghai Composite has been doing over the last couple of decades, but I also care how it's doing tactically, right? So every single one of these indexes and stocks and sectors, for that matter, we are looking at on multiple time frames. So I know we've looked at this chart a couple of times, but guys, I mean, the London FTSE 100, I cannot possibly be bearish equities as an asset class if the London FTSE 100 is breaking out of a 17-year base to new all-time highs. I can't look at somebody with a straight face and say that that is a bearish characteristic. So I think that this is another feather in the hat for the bulls. The German DAX closing at new 52-week highs this week is not a bearish characteristic, guys. This is one of the most important indexes on planet Earth, and I still think we're heading to 12,200 in the German DAX and then probably a lot higher after that. And then even if you want to, I mean, Ari brought up the frontier markets, or Jonathan Krinsky actually brought up the frontier markets, which you're really digging to the bottom of the barrel. I mean, those are the worst of the worst countries in the world, and you're seeing a bid. Here's Turkey, another example of a not so great country, equities-wise is what I'm referring to. Please, nobody take offense to it. And Turkey, this doesn't look like a bearish chart, guys. This, to me, looks like a healthy sideways consolidation that looks to resolve higher. So you got frontier markets breaking out, as Krinsky pointed out, and Turkey, of all places, looking good. I mean, it's not bearish. And then finally, with the global indexes, I wanted to show you guys, this is an equally weighted index of the top 10 global exchanges around the world, including Japan and London, the Shanghai, Brazil, Australia, Toronto, and it's equally weighted. And here we are breaking out to an all-time high. So when you talk about bad breath in the market, this is the opposite of bad breath. This is globally together in unison breaking out of close to a 10-year consolidation in U.S. equities now breaking out to a new all-time high. Guys, this is not a bearish characteristic. I think this is going a lot higher. So then what we want to do, now that we have perspective on the U.S. markets and the international markets, and both are suggesting to err on the long side of equities, then we want to look to the U.S. Sectors, individual sectors relative to the rest of the market. I know Ari touched on a few of those. I look at the top 10. Now there's 11 sectors relative to the overall market, again, on weekly and daily time horizons. And here's just a great example. I mean, this has to be my favorite relative chart. This is tech relative to the S&P 500, now just breaking out of a 16-year base, guys. So this, to me, says we need to be all over tech. I mean, for that matter, it's been suggesting to be all over tech. It's not anything new. But from a longer-term structural perspective, guys, this is a home run. And then another interesting one, I know Art Hill mentioned it. I believe Krinsky mentioned it too, and Greg Schnell this morning mentioned industrials. Guys, I mean, this is a monster base. You know, we're looking at, what, 6 years of sideways action in industrials relative to the S&P 500. This has breakout written all over it. And these are the Caterpillars, Honeywells, General Electrics of the world. You know, I really think they could be huge outperformers in the first half of this year. So here, the next thing we want to do, now that we have, we see where the relative strength is, now we want to look at each sector and subsector on their own, right? Forget the rest of the market. Let's just, you know, shut up and just trade what's in front of us sort of mentality, right? Steel looks very interesting, breaking out of a downtrend line that goes back almost a decade. This is not a bearish characteristic. This has been a home run. This is nothing new. But when prices achieve our targets, which target for our steel index was around 34 bucks. So after that, it's not our problem anymore. But we want to continue to observe how it's behaving. And ever since hitting our target here, it is behaving very well. These are not bearish characteristics. When I'm talking about breaking out above former support levels that turned into resistance, which was why